When people hear gold and silver, they think safety, they think stability, they think protection against chaos. But what most investors fail to understand is this: the biggest moves in financial history never happen when the crowd is comfortable. They happen when the system begins to crack beneath the surface. Right now, the warning signs are everywhere. Central banks are accumulating precious metals at record pace. Debt markets are under pressure. Global currencies are losing trust faster than governments can contain the narrative. And while the average person is distracted by headlines and short-term noise, smart money is positioning for something far bigger. This is not just another market cycle. This is a transfer of wealth unfolding in real time. The gold and silver markets are sending signals that cannot be ignored anymore. The next phase could shock millions of investors who waited too long to prepare. Today, we are going to break down why this moment matters, why the system is becoming increasingly fragile, and why those holding physical gold and silver may soon witness one of the most historic financial shifts of our generation. For decades, central banks around the world projected an image of confidence. They wanted the public to believe that modern monetary systems were stable, controlled, and backed by sophisticated economic planning. Governments repeated the same message over and over again: inflation was temporary, debt was manageable, currencies were secure, and financial institutions were strong enough to withstand any crisis. But behind closed doors, the behavior of central banks has been telling a completely different story. While the average investor focused on stock market rallies, real estate booms, and digital speculation, central banks quietly began accumulating one asset at a pace not seen in generations: gold. This is not random, it is not symbolic, it is not a coincidence. Central banks do not move billions of dollars into physical gold because they are nostalgic about history. They do it because they understand how fragile the current monetary system has become. They understand that confidence in fiat currency is built on perception, and once that perception begins to crack, the entire structure becomes vulnerable. Gold has survived every financial collapse, every currency reset, every inflationary disaster, and every debt crisis in recorded history. Paper currencies have come and gone. Empires have collapsed. Governments have defaulted. But gold remained valuable through every transition. The reason this matters today is because the world is entering a period of unprecedented financial pressure. Never before has the global economy been buried under this level of debt. Governments are printing currency at speeds that would have been considered unimaginable just 20 years ago. Interest payments alone are becoming unsustainable for many nations. Banking systems are carrying hidden risks that most people do not even realize exist. Central banks know this. They see the numbers long before the public does. They study the cracks forming beneath the system every single day. And instead of publicly admitting the danger, they prepare quietly. Look at the actions, not the words. That is where the truth always hides. For years, countries that once trusted the dominance of the US dollar have started diversifying their reserves. Nations across Asia, the Middle East, Eastern Europe, and even South America have accelerated gold purchases. They are reducing exposure to paper assets and increasing exposure to tangible reserves. Why? Because they understand that geopolitical tensions are rising, global trust is weakening, and weaponized finance has changed the game forever. When countries see reserves frozen, sanctions imposed, and international payment systems used as political weapons, they begin asking themselves one terrifying question: what happens if we are next? Gold becomes the answer. Gold does not depend on another government's promise. It does not rely on confidence in a banking institution. It does not need a digital network to function. It is not created out of thin air by policymakers pressing buttons inside central banks. Gold is independent. That independence becomes incredibly valuable during periods of uncertainty and distrust. What most people fail to understand is that central banks rarely move aggressively unless they see major instability ahead. These institutions are designed to project calm. Public panic is the last thing they want. But their recent actions reveal a level of concern that should capture everyone's attention. Record gold purchases are not happening during stable times. They are happening because the world financial system is becoming increasingly unstable beneath the surface. The average citizen still believes inflation is just a temporary inconvenience. They believe higher prices are annoying but manageable. They believe central banks remain in control. But history tells a darker story. Once governments become trapped in massive debt cycles, the temptation to inflate away obligations becomes almost irresistible. Printing money appears easier than imposing austerity. Politicians prefer currency debasement over public backlash. Central banks understand this cycle because they have studied every collapse that came before. They know what happens when debt spirals beyond control. They know what happens when confidence in government bonds weakens. They know what happens when purchasing power begins evaporating faster than wages can rise. And they know that when trust disappears from the financial system, investors rush toward hard assets. That is why gold matters so much in this moment. The public has been conditioned to think gold is outdated. Financial media spent years mocking precious metals while promoting endless speculation in risk assets. During stock market booms, gold was described as boring. During crypto rallies, gold was dismissed as old-fashioned. During periods of artificial economic optimism, very few people paid attention to what central banks were doing behind the scenes. But central banks themselves never abandoned gold. In fact, many of them increased their holdings dramatically while publicly encouraging confidence in paper systems. That contradiction should concern every investor. If fiat currencies are so secure, why are central banks buying massive amounts of gold? If inflation is under control, why are nations rushing to accumulate hard assets? If the financial system is truly stable, why is global demand for physical reserves exploding? These are not emotional questions, they are logical ones. There is another layer to this situation that most people still overlook. The world is slowly moving toward a multipolar financial system. For decades, global trade largely revolved around the US dollar, but today countries are exploring alternatives. Bilateral trade agreements are increasing. Discussions about commodity-backed systems are growing louder. Nations are becoming more cautious about dependence on any single currency system. Gold plays a critical role in that transition because it serves as neutral collateral between nations that may not trust each other politically. This is one reason central bank gold accumulation is accelerating. Gold becomes strategic during periods of global realignment. And right now, the world is entering one of the most volatile geopolitical environments in modern history. Wars, sanctions, supply chain disruptions, energy conflicts, banking instability, and rising debt levels are all converging at the same time. Every one of these factors increases pressure on the financial system. Central banks understand that crises rarely emerge from one source alone. Major breakdowns happen when multiple stresses collide simultaneously. That is exactly what appears to be forming today. The frightening reality is that most citizens are completely unprepared for what a true monetary crisis looks like. Modern generations have lived inside systems where digital balances appear infinite and central banks intervene whenever markets fall. People assume governments can always rescue the economy, but there are limits to intervention, there are limits to debt expansion, there are limits to confidence. History proves this over and over again. Every currency system eventually faces a test. Some survive through reform, others collapse entirely. Gold historically becomes one of the few assets that survives both scenarios. This is why central banks continue preparing. Another critical factor driving gold accumulation is the loss of trust in sovereign debt markets. Government bonds were once considered the safest assets on earth. But today, many nations face exploding deficits and rising borrowing costs simultaneously. This creates a dangerous feedback loop. Higher interest rates increase debt servicing costs. Larger deficits require more borrowing. More borrowing pressures bond markets further. Eventually, confidence begins eroding. Central banks know how dangerous this becomes. When faith weakens in sovereign debt, the entire foundation of modern finance starts shaking. Because government bonds underpin banking systems, pension funds, insurance structures, and global reserve management. If trust weakens there, panic spreads rapidly. Gold acts as protection against that systemic risk. This is not theory, it is historical reality. During periods of financial stress, investors consistently return to tangible stores of value, not because gold generates cash flow, not because gold produces dividends, but because gold exists outside the promises of governments and financial institutions. That distinction becomes critical during periods of instability. There is also growing concern surrounding currency debasement on a global scale. Nearly every major economy has expanded money supply aggressively over the last 2 decades. Some nations accelerated this process dramatically after crises and economic shutdowns. Trillions of dollars, euros, yen, and other currencies were created in astonishingly short periods of time. The long-term consequence of this policy is gradual erosion of purchasing power. Most people experience this through rising costs of food, housing, energy, healthcare, and transportation. But central banks experience it differently. They see the structural damage forming underneath the economy. They see how difficult it becomes to normalize policy without triggering recession. They see how addicted markets have become to cheap money and intervention. And they understand how dangerous this dependency truly is. This is why gold purchases matter more now than they did 20 years ago, because the world is entering territory where traditional solutions may no longer work effectively. The confidence game becomes harder to maintain when populations begin feeling economic pain directly. And once public trust weakens, financial systems can shift rapidly. Many investors still believe gold's value comes purely from fear. That is incomplete thinking. Gold's true value comes from durability across centuries of monetary change. Empires trusted it, kingdoms trusted it, modern nations still trust it, even after the creation of digital banking systems, algorithmic trading, and electronic currencies. Central banks continue storing physical gold in vaults. That fact alone speaks volumes. Technology changed markets. It did not eliminate the importance of trust, and gold remains one of the oldest forms of trust humanity has ever recognized. Central banks understand this deeply. That is why they prepare long before the public notices danger. By the time average investors fully recognize a monetary shift, the biggest moves have often already happened. This pattern repeats throughout history. The early stages appear quiet, then confidence suddenly changes, then markets react violently, then the public scrambles for protection after prices already exploded higher. What makes the current situation particularly dangerous is the scale of interconnected risk. Banking systems, debt markets, derivatives, housing markets, and global trade networks are now deeply tied together. Stress in one area spreads rapidly into another. Central banks know how fragile this interconnected structure has become. They know liquidity crises can emerge faster than ever in the digital age. And they know confidence can disappear overnight. Gold becomes insurance against that uncertainty, not insurance against one event, insurance against systemic instability itself. That is why central banks are not slowing down their accumulation. In many ways, their actions reveal more honesty than their speeches ever will. Publicly, officials continue discussing soft landings, economic resilience, and controlled inflation. Privately, reserve managers continue buying gold at historic pace. That contradiction should not be ignored, because institutions with the most access to financial data in the world are positioning themselves for turbulence ahead. And throughout history, whenever central banks quietly prepared for instability, ordinary citizens who ignored the warning signs paid the highest price through inflation, currency weakness, collapsing purchasing power, and financial uncertainty. For years. Silver has existed in the shadow of gold. Whenever people discuss precious metals, gold receives the headlines, the attention, and the institutional respect. Governments hold gold reserves. Financial media tracks gold prices daily. Central banks publicly acknowledge gold as a strategic monetary asset. But silver has always been different. Silver is underestimated, ignored, misunderstood, and historically, that is exactly when silver becomes the most dangerous asset to bet against. Most investors still fail to understand that silver is not just another precious metal. It occupies a unique position in the global economy, unlike almost any other asset in existence. Silver is both money and industry at the same time. It carries thousands of years of monetary history while simultaneously serving as one of the most critical industrial metals in the modern technological world. That combination creates explosive potential during periods of economic transition and monetary instability. Gold is primarily accumulated for wealth preservation. Silver, however, sits at the intersection of monetary fear and industrial necessity, and that is why many analysts believe silver could eventually outperform gold during the next major financial shift. The world is entering a period where demand for silver is increasing from multiple directions simultaneously. This is not speculation. This is structural reality. Modern economies rely heavily on silver because of its unmatched conductive properties. It is used in solar panels, electronics, medical equipment, military technology, batteries, telecommunications, electric vehicles, and advanced industrial systems. As nations push aggressively toward electrification and green energy expansion, silver demand continues growing at a pace the average investor barely notices. At the same time, the supply side of silver faces increasing pressure. This is where the situation becomes extremely interesting. Unlike gold, most silver is not mined from primary silver mines. A large percentage of global silver production comes as a byproduct of mining for other metals such as copper, zinc, and lead. That means silver supply cannot easily respond to rising prices. Even if silver demand surges dramatically, production growth may remain limited because mining companies are often focused on extracting entirely different metals. This creates a structural imbalance that few investors fully appreciate. When demand rises aggressively against constrained supply, markets eventually experience violent repricing, and silver has a long history of moving explosively once momentum begins. What makes silver particularly dangerous during monetary crises is its relatively small market size compared to gold. Gold markets are enormous and deeply liquid. Silver markets are much smaller, which means capital inflows can create far more dramatic price swings. A relatively modest shift of institutional money into silver can create price acceleration far beyond what most people expect. History demonstrates this repeatedly. Silver does not move slowly during major bull cycles. It erupts. When silver finally catches attention, price action becomes aggressive, emotional, and often chaotic. Investors who ignored it suddenly rush into the market all at once. Retail demand spikes, physical supply tightens, premiums rise, volatility explodes. The psychology around silver changes rapidly because silver behaves differently than most financial assets during periods of monetary distrust. The average investor tends to arrive too late because they underestimate how quickly sentiment can shift. One of the biggest reasons silver remains undervalued today is because many people still view it purely as an industrial commodity. They forget silver's monetary history entirely. For thousands of years, silver functioned as real money across civilizations. Entire economies operated on silver standards. Coins were minted from silver because populations trusted it as a store of value. Even today, during periods of inflation or currency instability, investors instinctively return to silver as protection against monetary debasement. That historical memory never fully disappears. It simply becomes dormant during periods of financial confidence. But once trust in fiat systems begins weakening, silver's monetary role reawakens rapidly. This matters because the world is entering an environment where trust in traditional systems is becoming increasingly fragile. Debt levels are exploding globally. Inflation pressures continue damaging purchasing power. Banking systems face rising stress. Geopolitical tensions are escalating. Currency confidence is weakening in many parts of the world. Central banks themselves are aggressively accumulating gold reserves. All of these developments create conditions where precious metals become more attractive, but silver introduces another dimension entirely. Unlike gold, silver demand is tied directly to industrial expansion and technological transformation. That means silver can benefit from economic uncertainty and industrial growth simultaneously. Very few assets possess that dual advantage. Consider the global push toward renewable energy infrastructure. Solar technology alone consumes enormous quantities of silver because of its electrical conductivity. Governments worldwide are investing billions into energy transition programs. Manufacturers continue scaling production of electric vehicles and advanced electronics. Artificial intelligence systems, data centers, telecommunications equipment, and military technologies all require increasing amounts of conductive materials. Silver sits directly inside that demand chain. The irony is that while the world talks constantly about electrification and technological modernization, very few people discuss the metal essential to making much of that infrastructure function efficiently. Silver remains one of the most strategically important industrial resources on Earth, and yet it is still priced as if supply abundance will last forever. This disconnect cannot continue indefinitely. Another factor driving silver's long-term potential is the widening gap between paper silver markets and physical silver availability. Most people have no idea how leveraged precious metal markets truly are. Paper contracts representing silver often vastly exceed the amount of physical silver readily available for delivery. Under normal conditions, this system functions because most participants settle contracts financially rather than demanding actual metal. But during periods of panic or distrust, that dynamic changes. If enough investors suddenly demand physical delivery at the same time, pressure on the system intensifies rapidly. This is one reason physical silver premiums can surge dramatically during crises, even when official spot prices appear relatively stable. Real-world supply tightens faster than paper markets anticipate, and once confidence weakens in paper representations of metal, investors rush toward physical ownership. That behavioral shift becomes extremely important during systemic uncertainty. Silver also carries a psychological advantage over gold for many retail investors. Gold prices can appear intimidating to average citizens because of their high nominal value. Silver feels more accessible, more attainable, more practical for smaller investors seeking protection outside the financial system. During periods of monetary fear, this accessibility becomes powerful. Large populations can suddenly enter the silver market much faster than institutions expect. And because silver's market is relatively small, retail participation alone can create significant price pressure. This dynamic has happened before. When public interest in silver explodes, available inventories disappear rapidly, dealers experience shortages, delivery delays increase, premiums rise aggressively, and market psychology shifts from indifference to urgency almost overnight. The problem is that most investors only recognize silver's importance after the move has already begun. By then, emotions replace strategy. Fear of missing out replaces patience. Panic buying replaces disciplined accumulation. That is how silver historically behaves during major monetary transitions. There is also growing concern surrounding decades of price suppression allegations within silver markets. Many precious metals analysts believe silver prices have remained artificially constrained through derivative structures and paper market mechanisms. Whether every claim is accurate or not, one reality remains undeniable: silver prices appear disconnected from long-term supply and demand fundamentals. Industrial demand continues increasing, physical inventories face pressure, mining expansion remains difficult, monetary instability continues rising globally, and yet silver remains dramatically below inflation-adjusted historical highs. That discrepancy has attracted growing attention from institutional investors and independent analysts alike, because eventually markets tend to correct major imbalances, and when silver corrects, it rarely moves gradually. The gold to silver ratio is another critical factor many investors monitor closely. Historically, silver often outperforms gold during the later stages of precious metals bull markets. When capital begins flowing aggressively into the sector, silver tends to attract speculative momentum much faster because of its smaller market size and higher volatility. In previous cycles, silver delivered gains that significantly exceeded gold's percentage performance. This is why experienced precious metals investors watch silver so carefully during periods of economic instability. Gold often moves first as institutional protection. Silver then accelerates once broader market participation begins. That sequence has repeated throughout multiple historical cycles. Today's environment contains many ingredients associated with previous silver explosions: rising inflation fears, debt instability, geopolitical uncertainty, weakening currency confidence, increasing industrial demand, and growing distrust in traditional financial systems. What makes this cycle potentially even more extreme is the sheer scale of global debt and monetary expansion now embedded inside the system. Modern economies are far more leveraged than in previous decades. Governments are more dependent on monetary intervention than ever before. Financial markets are more interconnected and fragile, and populations are increasingly aware that purchasing power erosion is accelerating. Silver becomes extraordinarily attractive under those conditions, not because it is trendy, not because it is speculative hype, but because it occupies a